This video we'll quickly look at return on equity and return on assets. Equity is basically your total assets minus your total liabilities, and it is essentially the owner's interest in the company. And as an owner, you always want to know the return you're getting on the money that has been given to the company. To do this, click in C5 equals net income after taxes divided by shareholders' equity, and you get about 12%. The idea here is to understand and compare the figure with other companies that you might be interested in investing in. For example, if you have Cisco and you have Juniper, and Cisco is currently giving a return on equity of 12%, whereas Juniper is giving a return on equity of say 14%. Maybe you want to go with Juniper. The idea here is to use this and apply it to range of circumstances, whether it be investing, whether it be comparing this calculation with your competitor. You get the idea. The next ratio that I'm going to look at is return on assets. All companies have assets. Cisco has assets. Juniper has assets. And virtually every company has assets. But the idea is that you should have your assets set to an optimal level. You don't want to have assets which are not really generating any value for the company, because at the end of the day, if you're buying a lot of assets and they're not generating any income, this means that they're going to eat up on your bottom line. To calculate return on assets, click on C12 equals earnings before income tax divided by total assets, and hit enter. Here you can see that return on your assets is about 4%. Things that you might want to consider here is the company efficiently using its assets? And if the number looks unrealistic, you want to ask yourself questions. Did they get new machinery? Or did they get new assets? Or did the assets that they had are no longer, they're not up to date, or they're obsolete? These sort of questions are some of the things that you should be asking. And the idea here again is to, if you're investing in different companies and you're making up your mind, the idea is to understand which one to invest in, which company is more effectively using its assets. To get a better understanding of the percentage of the return on assets, pay close attention to the notes in the statements to understand why this number is say 10% or why this number is 5%. Usually the statements or the notes to the statements will tell you the reasons. If they are big enough or substantial, that you would have a note in the statements.